Don't know how to keep you. Don't know how to keep you. Don't know how to keep you. How to keep you.
Hello and thanks for joining us again for another video here at 5 Latrobe Terrace, Paddington at the Profectus office. And we're lucky enough to have Graham Curry here from Profectus Accountants to assist us with some questions that we have about purchasing property in super and of course the tax implications of buying and selling property. So Graham, thanks for having us here and thanks for taking your time out of your day.
Not a problem at all. Thanks for having me.
Mate, Graham, so look, a question we often get asked by buyers and sellers is, okay, so buying in super, that's a new thing these days where, you know, we had some issues with super in the past with people losing some funds, and obviously the government's come out with new incentives to purchase and buy investment properties in super. I guess one of the big questions we get is, I guess firstly, what are the pros and cons, you know?
The pros and cons are that super, you generally have a larger equity base within super.
Gotcha.
So when you go buy an investment property in your own name, you're generally borrowing 100, 105%.
Yeah,
within
true.
super, you're borrowing 60 to 70%, giving you a lot less interest payable against the property. So when we're looking at growth aspects of a property, we're looking to see that the income that you're producing for the property is not being eaten away by the interest that you're being paid.
Yeah, good to know.
Which is a nice result. It also means it's got a risk reduction because of it's not all related to your income. It's related to the super contribution that your employer's paying for you. So when we're looking at, you know, a $20,000 to $25,000 input into super, and we've already got a high income coming in from the rent less the expenses for the interest, that shortfall is greatly reduced, making it a easier and long-term investment to hold.
Got you. Well, there you go. That's obviously pretty important. So keep in mind it's the contribution that you have to keep your focus on in your super, not necessarily obviously, you know, your standard 9.5%. You know, it could be more or less, of course, Graham. So I guess, you know, okay, what are the must-haves? I understand there are some restrictions in living and not living in it, and also a company set up and the tax side of things. How does that work?
Very much so. So the important thing is the super fund has rules around the property you can buy. So if you buy an investment property and you'd love to buy a unit at the beach so you can go use it, you
we
can't.
all would.
It will be lovely, but that is just one thing you just can't do.
Yeah.
So if we buy a property, it is for the sole purpose of retirement benefits, meaning that you just can't get any benefit out of it today.
Yeah,
so you buy something that is purely as an investment, don't try use it.
There you go.
Yeah, no, that's important. What I actually think super doesn't have the tax-driven nature of an investment property. When you buy it in your own name, you're looking to get deductions. So we're
Correct.
on 30 or 40%. Super's only got a 15-cent tax rate.
Gotcha.
So we're not looking for a property that has a lot of losses within it.
Gotcha.
A really nice second-hand property with a lot of land is a great thing to buy because we're not looking for a massive deduction.
Gotcha.
You go buy that beach unit, it's going to have a lot of deductions, which is great for yourself in your own name, but at 15 cents, you don't really looking for
That's
that.
an important note.
Yeah.
Yeah, okay. Well, look, you know, that's obviously some really important information about tax and about the super, and the tax implications and what you can and can't do. So as Graham said, big land assets, don't worry too much about the negative gearing, too much about that sort of investment. Okay, it's about the long term. It's a whole retirement, and as we know in Australia, long-term property market is always a good property market. So
it's hold it long term, and we're going to do very well out of
exactly.
it. Absolutely. Yeah.
But look, lastly, one other question I get often is, okay, so question for you. I purchase a property, I live in it for 4 years as my primary residence. Now, after the 4 years, I decide to rent this property out for another 4 years. Now, that property gets rented out for 4 years, and after that 4 years, I want to sell it. Now, I understand the capital gain is the taxable portion here, if I'm not wrong. How's that calculated, and how does it go about getting done, I guess, and how do you How do you figure that
It's a very important thing and actually rather complex. So for the purpose of a quick video like
Yeah.
this, I will say go speak to your accountant. But the important thing is that you get your agent involved in that process. You want to get a valuation at the day you move out. That actually resets, so that tells me where the capital gains base is starting from, because it's actually capital gains tax free while you have it as a home.
Correct.
Then there's some other things about deeming, and you can deem it to be principal place of residence for 6 years, but we won't go through that. But
just call Graham for that later.
exactly.
Okay.
But the important one is that we want to reset the cost base. And from that point forward, you hold it for 4 years, whatever growth you have in that, less the expenses of selling, that's what we call that capital gain.
That's the capital gain, that's how
Very
it's
much
taxed.
so. Yep.
Well guys, I hope I answered heaps of your questions. Any more questions, as always, please do reach out. Let me know. I am fortunate enough to have a lot of a lot of good professionals around me to assist, like Graham. And I'll leave his details after this video if you do need to have a chat with him about your property and anything accounting, of course. Graham, thanks again for your time.
Thank you.
Really appreciate
the time.
Thanks, guys.
Thanks a lot. See you later.
See ya.